go ahead and get started.
Okay.
My name is Grant Swartzwelder, President of OTA Environmental Solutions, and happy to be hosting the Oilfield Strong webinar series. As you all know, it's the first Wednesday of every month. So next one will be in 2022, so stay tuned for that. But if you do miss any or you want to go hear any of the previous ones, we do have a YouTube channel. Just go on to YouTube and search for OTA compression and you'll find that. And if you join it, you'll be updated with various websites. One of our previous speakers with ESG Dynamics just spoke at a conference 2 days ago, and that's just been loaded on. So a pretty interesting talk on some ESG metrics and how it affects the Permian. With that, though, we are here to talk to Jake Plunk, a longtime friend, and he's a success story in that he was able to overcome him going to Texas Tech to become a successful oilfield manager and entrepreneur. You like that introduction, Jake?
Yeah, it sounds like I'm the tallest midget, Grant.
There we go. It's see, I like inviting people and then sitting them up for my pummeling. So welcome. You're now stuck. But now seriously, he was has 20 plus years of experience in the oil field, from a business development, from investor relations, working with equity folks, working on operations. So diverse experience. Probably one of I think his claim to fame is the amount of acquisitions he's done. I think it's in the several billion, 5-6 billion when he was over at Merritt. And now that he's over in Florida Lee, where he's serving as CEO. So the idea is that we are going to talk about the acquisition market, kind of the availability of capital. A lot of what he looks at are the larger transactions. He can either take us there or we can go general. And then underlying kind of some of the things that are pushing issues for the A&D market, be it environmental issues or, again, capital. So with that, Jake, thanks for coming. I'll limit my snarkiness so that you might do this again. Right. But why don't I give you a softball, because of this aforementioned Texas Tech deal, to say, tell me, what do you think the acquisition market is? And if you could talk not just Permian, because I know you've got great experience in the Bakken and a variety of other areas, I think that would be interesting to see how the different markets are looking.
Sure. I would say the general theme across all of the basins, whether it's, private or public, we're seeing, there has been a lot of basin consolidation just in general. We've seen consolidation in the Bakken. We've seen consolidation in the Midland Basin and the Southern Midland Basin. And I think that's a general theme that we're going to continue to see. Obviously, 2020 was an anomaly. We were kind of call it a $40 to $50 billion kind of annual transactions is what you saw, whether it be private equity buying in, whether it be public companies, mergers, guys that were willing to take stock. I mean, that's kind of the universe that we live in, is kind of that $40 billion world. And in 2020, that number was close to 9 billion. And so it was a huge, there was just a lot of paralyzation of the markets, whether it be capital availability, whether it be just, a lot of companies had so much debt that there wasn't a clearing price without going into bankruptcy. So I think that was, the theme for 2020 was definitely just, there was not a lot of transactions. The buyers and seller universe just could not come to the table. And so obviously 2021, we've seen a huge bounce back in activity levels, whether it be, you look at guys like Pioneer, who, they did the Parsley deal kind of late in 2020, and then they've done the Double Point deal in 2021. You've seen some additional transactions from Diamondback and Chesapeake and Viper and Callan and Southwestern. I mean, there's just, the list goes on. So I think that's something that we'll continue to see, guys that are acquisitive and have capital and access to capital will continue to look at being, kind of these basin consolidators. On the private equity side, there is still private equity out there. There tends to be, I think, more of a focus to have less teams and more kind of scale and size, and and there's a lot of reasons for that. It's G&A savings, it's other just it's really more of just the trying to be a low cost producer, whether it's on an LOE basis or a G&A basis, and having less teams is probably a trend that will continue. And then lastly, I think as far as deals that are in the market, we're continuing to see, I think the fourth quarter, the deals that have been announced so far, you're probably not going to see a ton more activity in 2021. I think everything that has been announced has probably been in process for several months. And between now and the end of the year, we're probably not going to see a ton more of announced deals. But then as you roll into the first quarter of 2022, I think we'll definitely see, there's several processes in place in the Barnett that are being, sold by, majors and large independents. We've got the Barnett, though you'll see some additional activity. I think natural gas prices kind of rebounding has definitely created a situation where you'll see there's some, I think, probably some additional assets that will be sold in the Fayetteville. And then obviously the Southern Midland Basin, there's 2 or 3 processes that are in that are active right now that I think those probably won't be announced till early next year.
Is there a general theme for these companies that are selling? Is it just they see good prices and it's time to take some money off, or are they recapitalizing or ESG stuff? What is there? Because a lot of these that you're talking about are pretty sizable deals.
Yeah, correct. Some of it is it's long dated capital. Some of it is that it's private equity that's selling that. These assets they would have really in a healthy A&D environment would have sold 2 or 3 years ago, because there's an argument that even 2019, when you look at 2019 compared to previous years, 2019 was a $22 billion kind of transaction. So the industry was already becoming capital constrained, and deals were getting harder to do in 19. And then obviously during 2020, as you got into the pandemic, it kind of pushed things over a cliff, and it's taken 18 months to 2 years to kind of rectify some of those issues. But it's kind of 3 things. I mean, number one, I think there's been some sales due to ESG pressures. You can argue that, like Shell selling out of the Delaware to Conoco. I think a lot of that is ESG focused. There's some of it is pay down debt. Oxy's had several processes that they've run to try to pay down debt from the Anadarko acquisition they did a couple of years ago. And then some of it's just portfolio cleanup. And I think that's, areas like the Barnett and the Fayetteville and, kind of fringe assets in the Permian that may be sold by various, whether it's, Northwest Shelf or Central Basin Platform that we've seen from like, Conoco and Oxy and other and Apache. You've seen several of those processes run. So I think that's for the larger guys, it's either kind of ESG debt reduction or portfolio cleanup. And then kind of the other things, the kind of the M&A combinations, it's really more about efficiencies. I mean, Cimarex and Cabot merging, Parsley and Pioneer, ConocoPhillips and Concho. A lot of that's just about, there's still a tremendous amount of capital that needs to be spent to develop those assets. And we're kind of in a world now where if you don't have kind of this bulletproof balance sheet and cash flow to fund a lot of that capital it's going to require to develop these assets over the next 5 to 25 years, you probably need to find a partner. And I think that's what a lot of those transactions that happened in the last 12 to 18 months have been part of as well.
So does the transaction of Parsley being bought by Pioneer and then them turning around and selling the Delaware to Continental, does that kind of fit with all that? Or I was a little surprised that in one way them keeping just the Midland Basin makes sense, but then to turn it right around, and it seems like they pushed it on out and wasn't the best price, but you tell me.
I think from a valuation standpoint, I'm sure Pioneer was happy with the valuation. Okay. In order to get to that kind of valuation, you're probably looking at a scenario where Continental is going to they're going to have to grow into that position with the drill bit. And obviously there's a large capital commitment that will be required. And I think that was an asset that, obviously when Pioneer buys a Parsley, there's always going to be assets that maybe don't fit their core strategy. And I think the Delaware was probably that was that asset for them. And because that was mostly the Jagged Peak assets that Parsley had bought back in I think it was either late 18 or early 19. So I think that overall, I think Parsley's probably pretty happy with the result of getting, that asset moved and to another kind of large public that's capable of funding that development and being able to and it was a good entry for Continental to get into the Delaware. I mean, it makes sense kind of for the buyers and the sellers there, and those are the type of deals you typically like to see.
So when you're looking at who might be buying these assets, it's I guess the Continental deal might be one where they're looking to get into more of a growth area, or but it just seems like there's only once you go and do a $3 billion deal or even a $500 million deal, you've got to digest that. And so that eliminates you. And don't you run out of buyers at some point of those mega deals?
I wouldn't say you run out. I mean, it's obviously it's a very limited set of buyers. It's not, and you can go the other way too, right? I mean, somebody can come in and buy a $500 million deal and sell it down over the next couple of years to 10 different $50 million buyers. I mean, I always like to say those are the type of deals you like to buy wholesale and sell retail, and we've done that in our history. I mean, we bought some deals where it was kind of an asset package. You looked at it and it's like, well, it really makes sense to maybe sell in 3 or 4 pieces, but the seller's a large public that rather deal with one PSA, one set of buyers, one capital structure. And then ultimately we may have sold those assets over the next 2 years to maybe 3 different buyers. And if you're willing to spend the time to go through that pain, then that's definitely something that, and we optimized our value. It turned out to be a good result for us and our capital and providers. And it was I would say it was a successful, transaction and round trip. The other thing that you kind of look at with these guys, I mean, and Continental is probably a good example, is, you need a certain amount of scale to go into a new basin and have that new, they're not going to go do a $50 million transaction. They needed to do something with size and scale and the ability to, again, create efficiencies, because right now it's all about that to sell to the public markets. And that's what you're going to have to do to get your investor base to agree that these are accretive transactions that make sense long term for the company.
So we're talking about selling, but then so many folks that I hear, they say, well, you can't look to flip. You've got to just cash flow it. You got to be prepared to just hold it. So it's, if people just listen to the first part, they'd say, well, you could buy it and flip it and all, but that kind of, how does that contrast with the thought that you just need to hold it and you better plan on owning that for a while, and maybe that's how you get your money?
Sure. And I think that always needs to be kind of the option you look at. That should be your hold case, is that if I hold this asset for 5, 10, 15 years, what is the multiple on my money I'm going to get? Typically, when I was my days at Merit, we would always look at our PV0. And so what were we paying for an asset? And what was our PV0? Are we going to get our money back? Because the first rule especially as a PDP buyer, the first rule of that is, never lose money. I can explain maybe a substandard return. The return may not be the frothy private equity kind of 18, 20, 30% return. But if I hold the asset long enough, run my business the way I should, and cash flow it for the next 15 years, does that generate enough cash flow to get my money back and get my investors' money back? And so I think that's kind of like the first point of PDP buying is, do we get our money back in this deal, regardless of how long we have to hold it? And
Wouldn't
then,
the biggest driver of that just be hedging your price? Because that's,
oh,
yeah, you can operate, but that's, you're talking, I would think 10 or 20% swing. Maybe you could bring a little production in, but it's all price, isn't it?
well, it's not just price. Price is something that, again, I can't control. You're a market, you're more of a market taker than a market maker. So, we can, but there's things we can do around price to mitigate those risks. We can hedge it. We can, you can run certain, different scenarios to see, okay, at this price deck, do I get my money back or not? I think the biggest thing, and this happens a lot on the acquisition side, and this is why I always say technical people matter, and that if if you pay a certain price for an asset and you miss the reserves, so the evaluators, the evaluations engineers, they are quite honestly, they're controlling a lot of that back end of those returns and the back end of that process, because if they miss the reserves by 50% or 20%, it doesn't matter if oil goes to $200 a barrel. There is nothing I can do to generate a return on those assets if I miss the reserve. So it's really a lot about the evaluation process and having really good evaluators on your team. And some of these guys, I mean, honestly, a really good evaluations engineer, I mean, I can hire drilling engineers and completions engineers and all these guys, but a really good evaluations engineer kind of takes a lot of those skill set. You got to have enough reservoir engineering to understand the reservoir. You've got to understand operations as far as cost cutting and what can I do to make this asset work. But the evaluations engineers, they're kind of ghosts in this industry. And when you find a really good one, and unfortunately, I've been able to work with a few in my career, and at one point, years and years ago, I might have been a decent one. I've obviously worked with guys that are much better than I am, but I think that's really the key to the acquisition success, is not missing the reserves.
Interesting. Okay. Well, let's move over to the private equity side. And I want some hot sports opinions about what's going to happen on this, the private equity market. And, it just seems there's so much money out there. There were so many private equity groups out there. I just, my naive approach is that there's not going to be as many of those, or they're going to be obviously a lot less money for each of them. But then if they have less money, but to your point, they need to have bigger deals, that seems to be a little contrarian too, or contradictory.
I think there is still, a well-funded private equity market that does exist. There's still a lot of dry powder by a lot of the big private equity names. There's guys that have capital. I think that capital is currently going to be much more, they're going to be much more prudent as to how they deploy that capital, whether it be via the drill bit on existing portfolio and existing assets, whether it be on new acquisitions. I think that you're going to see it is going to be more difficult to get, private equity to go do $1 billion transaction up front and then know that you've got to spend $1 billion of capital to develop those assets. So those will be challenged. I think that a lot of the capital, where a lot of the call it the limited partners, where that capital is coming from, that's where probably the biggest constraint is going to continue to come from, is the traditional, let's just say, public pensions, endowments, foundations. Those guys are definitely, they're either out of the market or they're cutting back their allocations. And so I think that's something that is going to be an issue that we're going to have to deal with going forward, as to how you capitalize these new acquisitions and how you raise funds. And so, XYZ, private equity firm, if they were 80% endowments and foundations 10 years ago, and they were able to raise a $2 billion fund, well, that number may be 750 or 500 today. And so it's not that those guys are out of the energy business, but it's definitely a challenge. And a lot of them have gone to where they're only going to contribute to existing managers. So if you're a new fund and you're looking to raise capital, it's going to be a challenge to go out and get funding from that type of source. So it's not that the spigot is open for capital raises for anyone in the kind of upstream energy business. There's some money for alternatives. There's some money for water. There's some for infrastructure in kind of midstream type assets. But I think for upstream oil and gas, it's definitely a new dynamic as far as how do you capitalize these assets.
Well, it seems like what some are doing is they're slapping in a ESG component or energy transition or alternative energy or whatever you want to call it to allow them to go raise some money. And back to your comment about you don't want to lose money, you maybe get a lower return, but some of those things sure seems like they're opening up the potential to have some interesting outcomes.
Yeah, and I think as long as the expectations are there for the ESG investor, that it will be lower returns, just because the cost of the operating those assets or rectifying prior operator problems or prior operator neglect may be something that you're going to have to spend dollars on to create that momentum of, hey, this year we were X% less emissions or less percent, of whatever metric we're gonna kind of have going forward for, what is how much did I reduce my emissions from 2021 to 2022 and beyond. I think as long as the expectations are there, I think there probably is money for those type of investments. It's just going to be a lower return type of market.
And what you're talking about, I think, is ESG, improving the environmental for the upstream E&P. I was actually alluding to how it seems like almost all these large private equity, they now have a part of their fund or more going into solar or battery or
charging stations. Yeah, you name it. Right.
And completely going beyond the upstream side. And that's how they're able to raise money, because they're not raising money for E&P upstream as much.
Right. No, that's correct. And that's a totally different, either fund or business model that X% has to be kind of towards that new, type. But I will say this is, again, getting back to returns, because money is green and everybody likes to make money on the investment side. If those investments don't generate returns, then there will be another process or another iteration of what is ESG investing.
Well, and time will prove either side, but boy, it sure seems like there's some expectation that those yields are not going to be near what people think, and then they're going to be kind of scratching their head as to whether they want to keep talking the green story.
Right.
So it's
again, all these guys have to answer to investment committees, and I know that's another challenge. Like I said, even pre-pandemic, there was a reason in 2019 that things really were challenged, and there was a lot of capital that was literally destroyed from about 2014 or go back to 2012. There was a lot of capital that was destroyed in that 7-year period that people were starting to realize, and you had downturns in kind of late 14 and 16, and there were these 2-year cycles where we had prices kind of all over the board. And I think that 2019 was kind of an indicator that the investor base was realizing that, okay, these returns aren't here. What do I need to do to make better returns? And they're like, well, I'm not going to invest in energy, period. And then when we got into the pandemic, things just got really worse. And so
spiral.
It was a perfect storm of bad returns over multiple years. And again, some private equity funds made out great, but it was usually on the exit to publics during that period of time. There were guys that leased a bunch of acreage in a certain basin and were able to flip it to a public that needed inventory. And so those stories, were great for that set of investors. But, there was a lot of capital that was spent, whether it's acreage leasing and drilling and other things that, there were literally billions of dollars in certain investments that were destroyed. And the entire industry was punished for that by the end of 2019 and into 2020.
So where do you see ESG and all the talk and actions and regulation, look into your crystal ball and say over the next several years how that's going to affect the industry and help affect private equity and kind of your A&D efforts and others?
So ESG is not going away. I mean, that's one thing that I think we should all be prepared for and be aware of, that's something that we're just going to have to deal with moving forward. And there's aspects of, there's the environmental side, which is kind of a different bucket that we all need to be, I think the first thing is actually an honest measuring of emissions and flaring and these other things. And what's frustrating, at least to me, is that if there was an open dialogue, or at least a fair dialogue between the people that are pushing a lot of this, potential legislation and zero emissions by 2030 and all these other different things, if there was a real kind of honest discussion that we could have with those people, because there's some really smart people in the oil and gas industry, and I am not one of them, but I get to be around a lot of them, and I will tell you that a lot of these problems can be solved, but it needs to be, an open dialogue and like, okay, here's what can be done. And this is going to be the cost. And this is going to be like, okay, guess what? Your electricity bill is going to be higher. The amount of money that you spend at the pump is going to be higher. And that's just a fact. And what the media and other people portray is like, oh, we can just do all of this stuff. And the cost is going to be the same. And so if we could have that discussion and be really open and honest about the ramifications of what it would require to do these things, then that's great. But the thing that frustrates me about a lot of the other, the S&G piece of it is it requires a totally kind of turnover in how, management teams are looked at, just the entire the employees that are in the industry. There's a lot of things that I think are not really fairly portrayed, because a lot of where is most of the oil and gas production in the US? Well, it's in places in West Texas that, the oil and gas community is a large employer and a large provider of really good jobs and other things in these small communities. And it's in, Casper, Wyoming, or, Gillette, Wyoming, or Andrews, Texas, or places, in Oklahoma. And I think that gets lost in like, what does the oil and gas community, or what does the oil and gas industry provide? And I don't think that's really recognized in a lot of what we call, that's the social side of that's the S and the ESG that I think kind of gets lost in oil and gas and in general. So anyway, that's my view. And then the governance side of it, I mean, that's more for, public company guys to worry about. Us being private all these years, it hasn't been on our radar for a number of years, but, that's definitely something that, diversity in the boardroom and diversity in management teams, that's fantastic. And I support all that. I mean, my wife is a petroleum engineer, and she, has a lot of things that, she's got certain opinions that she has. And I will tell you, as a woman being in this industry, that it was really tough for her coming out of college and working with,
I can see that.
Other engineers and managers and things, just being a woman in the oil field. And so there is definitely it's a challenge we would encourage women and minorities to come into this industry, and how's the best way to facilitate that, because it has to start at the university level, because without the proper training and education, it's very difficult to come into this industry without having the proper education.
No, I agree with so many of those thoughts. It's I guess, specifically, I would think that ESG, it's going to create more cost and potential for more liability and more reporting. And that just creates a more arduous way of doing business.
Correct.
So it's, well, with those happy thoughts, it is now 2:00, and you have a more positive ending, Jake, that you'd rather?
Yeah, listen, I love this business. Absolutely love this business. And I'm optimistic that, over time, a lot of this stuff will work itself out. And we are, the oil and gas industry is not going away. It's absolutely not. I'm not one that's going to get in a battery powered airplane anytime soon, because I was driving back from New Mexico back this summer. It was like in May, and there had been a cold front moved through the panhandle of Texas and northern New Mexico. And we're driving back with my family, and there were 4 Teslas on the side of the road with their blinkers on.
Oops.
And it's because it was cold, so they had to run their heaters. They were having to run their windshield wipers, and that drains battery power. And so they thought they could make it from Amarillo to Childress from a charging station. They couldn't get there. So there's definitely, we're not, as many electric vehicle sales and everything, we are not there yet. And we're probably a really long ways away from, other than having an electric vehicle that you plug into your garage, you drive to work and back every day, and you charge it back in when you get home. That large, long travel transportation is still a real challenge with EVs, and it will be, I think, for a long time, because look, we have this planned obsolescence with our cell phones. Your cell phone only lasts 2 years, and if people think they're going to go buy a $70,000 EV every 2 years or 3 years because the battery technology is not there yet, then what do you do with all that stuff? So I think we're, and I think that gas powered vehicles, diesel power, whether it be locomotives, large truck transportations, everything else. I feel like this industry is not going away. We need to do a better job, I think, as an industry to educate the public that's going to happen, and there are ways that we can reduce emissions and be better stewards of the environment.
I hear so many people say we need to better educate folks, and but I don't. It's so fragmented. It seems like there's about 10 companies need to come together, put $1 million in, and start a real promotional campaign. But doubt that's going to happen either. Yeah. But well, Jake, thank you for your time. Hope everyone found this enjoyable. It'll be on YouTube in about a day, so if you want to soak in more Jake Plunk, then you have that opportunity. Otherwise, first Wednesday of January, we will see you back here for another episode of Oilfield Strong. Thank you, Jake. You have a great holiday.
All right. Thank you.